stocks, mutual funds, index funds, and ETFs. These are some of the common financial instruments that you might have heard of at some point in your life, but may not fully understand. What are they, and how do they work? Well, we are Simple Money, who explains financial concepts in simple language. In this video, I'm going to explain the basics of these common financial instruments in simple terms. Here's a list of what we'll cover. If you're interested in a particular topic, timestamps will be available in the description. So, let's get started. Let's start with something basic. Stocks. It's one of the simplest financial instruments to understand. Most of you probably already know what it is, but let's talk about it for those who may have heard of it but aren't sure what it entails. Basically, a stock is a stake in a company. Not this stake, an ownership stake. This means if you buy one share of a company, you also become the owner of that company by one share or stock. Let's say there's a company, we'll call it Company A, worth 100 crore. To divide ownership of the company, they decide to issue stocks. Let's say they issue 1 crore stocks in the market. Each stock would cost around 100 rupees. So, if you buy one share of Company A, you buy a part in his company, well, whatever comes in 100 rupees because his company is actually very big, like 100 crore, so you would become an owner by like 0.00001%. If you want a bigger share, you'll need to buy more stocks. Now, you might wonder why an owner would sell parts of their own company. We'll explore that in our next topic, IPOs and FPOs. When a company issues its stock for the first time, it's called an IPO or initial public offering. And if the owner decides to issue more stock after some years, it's called an FPO or follow-on public offering. But why do they do it? Mainly to raise funds for expanding the company. Let's take my friend Johnny as an example. He owns a company that's doing well, but wants to expand. However, he lacks funds. So what does he do? He sells parts of his company to raise those funds, or in other words, he launches an IPO. There are various ways to raise funds, but this is a common one for substantial fundraising. Now, you might wonder why he'd issue more stock later, known as an FPO. Well, there could be several reasons, but for simplicity, let's say maybe the demand for his company is so high that the stock prices rise significantly. This makes it difficult for regular people to afford, so he issues more stock to dilute the price, making it more accessible. For example, his company is worth 100 crore, there is already 50 lakh stock of his company in the market. So each stock will cost around 200 rupees, which is too much for people to buy. So he will release 50 lakhs more stock, thus dividing his company into more parts and reducing the stock prices to 100 rupees so that anyone can buy it. Now, if that's clear, let's move on to our next topic. Remember how stocks are a way of raising money for a company's expansion? Well, bonds offer an alternative method. Instead of issuing stock, the owner can take a loan from the public. In this method, the owner borrows money from the general public and pays fixed interest on the loan every year, like around 7%. This is similar to taking a loan from a bank, but instead of borrowing, you're lending money to the companies or even the government. Yes, government also take loans from the general public for specific plans or schemes, and then return it with some predetermined interest rate. Now, if it's clear, let's talk about debentures. Debentures are similar to bonds. Companies borrow money from individuals, but unlike bonds, there's no collateral involved. It's purely based on trust. For example, if my friend Johnny here wants to buy a car worth 5 lakhs and asks you for a loan of 5 lakhs, and to get that loan from you, he offered you some jewelry, which is also worth around 5 lakhs, for security. As if he for any reasons was not able to repay your money back, you can sell his jewelry to recover you money. This isn't bonds concepts. But if he asks you for a loan of 5 lakhs, and you give it to him out of trust that he will repay you, without taking any securities like jewelry, then it will be a debenture concept. It's a bit riskier, and it's typically used by smaller companies, not usually by the government. Now, let's move on to the next topic. Now, what are mutual funds? To put it simply, let's say you want to make some investments, but you lack knowledge and the confidence to do it. So what will you do? You will invest in mutual funds, which basically means, well, instead of making investments yourself, you give your money to a company and they invest it on your behalf. They charge a small fee for this service. There are various types of mutual funds, indicating where the company will invest your money. For instance, if you're comfortable with risk and want to invest in stocks, you choose a mutual fund that specializes in stocks. If you prefer lower risk, you opt for a bond mutual fund. Essentially, you're entrusting your money to experts who invest it according to your preferences. It's that simple. Now let's talk about index funds. Index funds work similarly, but instead of active management, they track specific market indices, like the Nifty or S&P 500. These indices determine the performance of top companies, and by investing in index funds, your money is distributed across those companies accordingly as they are in those indices. Well, if you never heard of indices or index, like Nifty or S&P 500, or you have heard it but don't know what it is, let me explain. So for example, take Nifty. Well, Nifty basically track performance of top 50 companies' stock in India, which is registered under NSE. To simply put it, it's just a mathematical calculation which takes all the stock price movement of top 50 companies and then calculate them into single price movement to determine whether they are going up or not. And if you invest in index fund, it basically means you are giving your money to a company, and that company is going to invest your money in companies accordingly to an index you chose. Like if you invest in Nifty Index Fund, the index fund company will invest your money in the same company in same proportion that is in Nifty. If you understand this, let's move on to the next topic. ETFs, or exchange-traded funds, are like a mix between mutual funds and stocks. Similar to mutual funds, they pool money from investors to buy a diversified portfolio of assets. But unlike mutual funds, ETF shares are traded on stock exchanges throughout the day. This means you can buy or sell ETF shares anytime during market hours at the prevailing market price. So ETFs are like mutual funds, but unlike mutual funds, where you give your money directly to a firm for investment, let's say 500 rupees, in ETFs you will buy ETFs which are like stocks. So if one ETF costs for 250, then you can buy two ETF if you want to invest 500 rupees, but it's not usually used for investment, it is mainly used for trading. But after that, in technicality it's almost same. The companies will then invest your money accordingly to whatever ETF you bought. So now if you understand it, let's move on to our next topic. Options and futures can be a bit complicated, but let's give it a shot. For now, think of them as similar. Options are financial contracts giving the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price by a specified expiration date. It might sound complex, but let's simplify it with an example. Say you expect the price of a car to increase from 5 lakhs to 6 lakhs next month, but you are not sure, as there is a possibility that the prices may go down actually. So, you can enter into a contract with the dealer to buy the car at the current price of 5 lakhs next month, regardless of the actual market price. Like whether it increases to 6 lakhs or decreases to 4 lakhs, and for that you pay a premium for this option of 50,000. Now if the price goes up to 6 lakhs, you make a profit of 1 lakhs by buying the car at 5 lakhs, well not 1 lakh, actually 50,000, as you paid 50,000 premium earlier. But what if the price goes down? Well, if it goes down to let's say 4 lakhs, you can just choose to not to buy the car, but you will still lose the premium paid earlier, which is 50,000. This is an options concept. Now let's talk about the future. Well, futures are similar but with a key difference. You're obligated to buy the asset at the agreed price, regardless of market fluctuations. Like if the price decreases to 4 lakhs, you still have to buy it for 4 lakhs, thus losing 1.5 lakhs in total. And well, of course, all that I yapped about just now is not about cars. Options and futures are for indices, like Nifty, or stocks, like Reliance, but the concept is same, just replace car with indices and stock. That will be the futures and options concept. And of course, this is just an overview. Options and futures are complex instruments that require more in-depth explanations, which is not possible in this video due to time constraint, as this video covers many financial instruments. But if you want an in-depth explanation on them, just comment, and I will make a video dedicated to futures and options explaining them in depth. Now, on to our final topic. Commodities are raw materials or agricultural products traded in bulk. They're divided into two types: hard commodities like metals, such as gold and silver, and energy, which includes crude oil and coal, etc., and soft commodities like agricultural products. For example, if you invest in gold, you're investing in commodities. It's a straightforward concept, and many people invest in commodities without even realizing it. Like many people probably have gold but don't know it is called a commodity, so basically, it's just a term, nothing else. And that wraps up our discussion. If you still have doubts about any topic, feel free to leave a comment, and I'll make a dedicated video to explain it further. If you find this helpful, consider subscribing for more content like this. And don't forget to like the video if you enjoyed it. That's all for now. Thanks for watching and see you next time.